The stock market got absolutely pulverized here today, with only about 5% of the components out there closing in the green. It was a washout day for the bears here today. In fact, the Nasdaq really took it on the chin here today. It was down nearly 4%, which was its worst day since September of 2020. We're now on track for the Nasdaq having its worst month since the 2008-2009 Great Financial Crisis. Things are getting really sketchy out there. Nasdaq is now down 20% just on a year-to-date basis. So of course, that means that our posture in tonight's video is going to largely be bearish across the board. But I do want to show you that if you pick and choose your bullish spots, you can still find success. And I want to show you some of our previous sold put examples and then put a new one on with a communication services stock that's approaching an attractive territory. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 26th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these free videos to YouTube. In addition to that, at the bottom of those emails, we'll tell you what stocks are giving you overbought and oversold cluster signals using the market forecast technical indicator. And I would imagine after a day like today, there's going to be a whole slew of oversold cluster signals in the S&P 500. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. If you're not doing so already, I would encourage you to follow me. In fact, this upcoming weekend, I'll be back in Omaha for Woodstock for Capitalists, the Berkshire Hathaway event. And it'll be my 16th year going back there. And as I typically do, I will be sure to tweet out any interesting things that I'm hearing from Warren Buffett and Charlie Munger, or just interesting things that I'm seeing around the city there. I'm not sure if I'll be quite as active on Twitter as I used to be in the past as a result of them actually doing the full meeting and the question and answer session live for everybody on the internet. So it's not quite as much of a novelty as it used to be. But nonetheless, if you're interested in my take there, feel free to follow me this upcoming weekend. Addition to that, we have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see here from our S&P 500 heat map, it was an absolute bloodbath. With the S&P 500 down well over 2%. You can see why that was the case. The standout from my perspective in terms of the worst offender here today was Tesla. You'll notice how bright red this big Tesla square is off to the right-hand side here. And a reminder that prior to today, it used to be $1 trillion company. After today, it is not, with Tesla's shares down 12% here today. Part of that ties into the story we've been talking about in this video the last couple of weeks with Elon Musk having bought out Twitter. Twitter is a smaller player. You can see it was actually down 4% today, despite the company accepting Elon Musk's bid for the company yesterday to buy it out for $54. It's actually trading right now just a hair below $50. So there's another $8 that has not been, or I'm sorry, 8% I should say, that has not been accounted for yet. But remember, there's a long ways to go before the deal is officially done. What we know at this point is that Twitter has accepted the bid, but we don't know exactly where Elon Musk is going to come up with his funding, and there is some fear that he will either have to sell some of his Tesla shares or at a minimum use them as collateral to receive loans from them, and that's starting to concern investors maybe a little bit more. Also, there's the theory out there that, Elon, while a great multitasker in the past, who knows, maybe he will eventually spread himself too thin when it comes to SpaceX and Tesla and now Twitter and all the other things that he's involved in. So that was part of the reason we saw Tesla shares absolutely get smashed here today, down 12%. But they weren't alone, so we don't want to unfairly pick on them. Amazon was down nearly 5% today. Google/Alphabet was down 3% in the normal market session. They then came out with earnings after hours tonight, and the shares fell nearly an additional $200 per share. However, the last I checked, they were rebounding. So the initial take on earnings was to sell the shares off even further, but they've kind of been able to get a little bit of those losses back in the after hours session. We'll see where it opens tomorrow. By the way, Microsoft also reported after the bell tonight. Same thing there. Their shares initially sold off a bit, but have actually rallied all the way back and are now trading a bit higher in the after hours session. Another stock that was trading lower after hours tonight in that tech space was Texas Instruments. It closed lower today in the normal session by 3%, but was down another $8 per share or thereabouts after hours. So, for the most part, we had a little bit of a negative tone after hours, and that was after the normal session bloodbath that we had. Of course, Apple, we should talk about it as well, as it is the most important player within the S&P 500 because it's the one with the biggest market cap. It was down 3.73% today as well. So pretty much anywhere you looked, there was a lot of selling going on. There were very few bright spots along the way, and most of them probably had something to do with earnings. I do know, as an example, Corning, which we were fortunate enough to buy just a couple of weeks ago in my dividend growth investing class. It was one of the rare winners here today. They reported earnings this morning, and therefore their stock was up about 3%. We also saw that Waste Management was up 5%, and their competitor Republic Services within the garbage space was up 1.9%. So they avoided the bloodshed here today. Lockheed Martin managed to close up just barely. We also had Roper Technologies, which is actually a dividend aristocrat. You don't hear me talk about it a whole lot because its dividend yield is puny, but they have raised their dividends for more than 25 years in a row. They had a nice day, up 3.68%. Speaking of aristocrats, Sherwin-Williams was actually, I believe, the biggest mover to the upside in the S&P 500 today. The paint company was up 9.4%. So much for the old saying of, it's so boring, it's like watching paint dry. In this case, watching paint was profitable here today, up 9%. You will see here in the energy area, we had a number of those higher as well. Marathon, Valero, Phillips 66, Williams, a handful of those closed a bit higher there. But you can see how difficult it is to look for any bright spots here. To put that into context a little bit further, we can come over here and take a look at the market breadth using the Market Watch Visualize area of the Thinkorswim platform. And I've got the S&P 500 public watch list pulled up here. And you'll notice that there were only 29 stocks that closed in the green today in the S&P 500. And so that comes out to about 5 or 6% of the market managed to close positive, which means nearly 95% of the S&P 500 closed in the red today. That is an extreme reading, an extreme washout day, right? We look at these statistics quite often during my presentations, and a lot of times it's pretty impactful if there's an 80-20 split. Today was kind of a 95-5 split, and it was an overwhelming washout there for the bears here today. I always like to pull up this chart whenever we have a big day, anything more than a 1% move, although the way that things have been so volatile here lately, I might have to move my hurdle there and only pull this up on days when we're down or up 2% or more. And today would have been one of those days as well, with the S&P 500 down 2.81%. You can see how ugly that candle was here today, or at least that red bar here. Remember, this zero line would be as though the market was flat for the day. If the market was up, it'll plot those green bars to the upside. If the market was down, it'll plot those red bars to the downside. And you can see here today was a tremendous sell-off day with this red bar coming coming way down below that orange 2% lower line right there. You'll also notice down below that the VIX spiked pretty tremendously. I know the VIX itself technically is a percentage, so you don't always read off a percentage increase or decrease off of an already percentage, but to put it into perspective, it was about a 25% move higher on the VIX today, and you can see where that kind of puts us back here at the end or middle of February. It was somewhat similar, and the VIX was up there in kind of that mid 30th percentile area. Right now, it ended today at about the 33 or the 33rd percentile, and so that's quite a far cry from where we were just a week or so ago. We were flirting with 20 on the VIX, and now all of a sudden we're back up at 33. And remind yourself that the VIX can have even more spectacular moves. So this really wasn't anything too dramatic. Remember back in the 08-09 crisis, we actually saw the VIX go all the way up to nearly 90. And even during the coronavirus time period, we saw the VIX up there 40, 50 in that kind of general vicinity. So yes, the VIX is pretty high here at 33, but there's no rule that says it can't get even higher. So we have to keep our eyes on the ball there. You can see how ugly the price action has been for the S&P 500. 4 out of the last 5 days to the downside, with the 3 out of the last 4 days tremendously lower, right? This one was kind of a non-event type of a candle, but this was a big candle, this was a big candle, and that was a big candle, and they were all closing at the lows pretty much of the sessions, telling you that the bears are still in control of this market here. Now, if you thought this was bad for the S&P 500, I also wanted to pull up the Nasdaq Composite. Some of you saw me tweeting about the Nasdaq earlier today. We're officially 20% lower on a year-to-date basis on the Nasdaq Composite. So I'm just pulling that up on the Thinkorswim platform using $comp. And you can see here in the year-to-date label, we are down 20% just since the beginning of the year. That wasn't even the high. Remember, with the NASDAQ, the high was placed back here at the end of November of 2021. So just on a year-to-date basis, we're down 20%. We're down even more than that from its true high. And again, notice we are hitting new lows here today as well. So not only was it important from the aspect of it kind of crossing that important 20% threshold, but it also broke through those prior support areas that were kind of holding in and were intact up until today, right? These other candles back here on the Nasdaq Composite from February and March, up until today, we're kind of holding that low. But after today and us closing at the lows of the session, we have now broken through those horizontal support levels there as well. But the other thing I wanted to show you here with the Nasdaq Composite, because today was a particularly aggressive day for the Nasdaq Composite. Take a look at this candle here, this bar. This red bar stretches not only to this orange line like we saw with the S&P 500, but it stretches well beyond this purple, or I should say maybe fuchsia would be the better way to describe it, this kind of pinkish color here, signifying the 3% level. And you can see that this is a 1 year, 1 day chart, meaning that we have basically 252 bars approximately of trading days that we're looking at over the past year, and this is the worst one on the board. In other words, this is the worst day of the past year for the Nasdaq Composite. If you were to come back a little bit further, so if I came in here to the time frame, changes from 1 year to 3 years instead, we want to keep that aggregation period daily, but if I hit the OK, you will see that the last time we had a day as bad as today in the NASDAQ, I know this kind of scrunches everything up, so you'll have to take my word for it here, but we would have to go all the way back to this day back here that I'm circling all the way off to the left-hand side. That was on September 8th, 2020. So we're talking about basically a year and a half ago, and on that day the Nasdaq was down about 4.11%, so just a hair worse than what we saw here today. So that should put things into perspective, especially for those of you who might be newer to the markets. If today felt like it was a gut-wrenching experience, you have every right to feel that way. Today was a gut-wrenching experience, and this puts that in perspective. Last time the Nasdaq was down this much in a single day was basically a year and a half ago, and that was a long, long time ago. And a lot of us maybe have forgotten what it felt like along the way, right? Of course, during the COVID time period, we did see a lot of days that were like this. But the thing that was maybe a little bit different about that time period, so let me kind of expand out the view here a little bit more. You'll notice here during this area that I'm kind of circling off towards the left, we had extremely aggressive moves up and down all over the place. This is extraordinarily rare. And here was that bloodbath that was COVID on the chart up above. But what kind of distinguishes it and being different from what we are used to throughout history is how quickly that was unwound. Within basically a couple of months, we had completely eliminated the losses of that 35% meltdown. Now, it's 35% on the S&P 500. I can't remember exactly what it was on the Nasdaq, but you get the point. This was a vicious percentage meltdown that we experienced in March of 2020, but by the end of the summer, or actually really the beginning of the summer here, end of May, beginning of June, we had completely washed out those losses, and we were right back in that uptrend. Now compare that to what we're dealing with over here. This is feeling like, death by 1,000 paper cuts type of a situation in comparison. This was done awfully quickly. This has been a continual, massacre in the tech names that really started all the way back here on November 22nd or whatever day that was. It's still interesting to me that we actually sold half of our Microsoft shares in my trend trading class on that day because that happened to be the day that we doubled our money in Microsoft. And we didn't know it at the time, but it actually ended up being the top for the entire Nasdaq as well. So it's kind of interesting how things shake out over time. But the other thing I should show you while we're looking at the Nasdaq Composite chart here that I kind of addressed briefly before, but we didn't have a chance to see it up close, is take a look here at how the VIX was kind of spiking back then as well. And to kind of put that into context a little bit better, let's bring up the S&P 500 using the 3-year because that's a little bit more in tune with what the actual reading of the VIX was. But you can see the VIX was up here at like 70, 80. Somewhere in that general vicinity back here in March of 2020. So again, yes, the VIX has spiked to 33 in real time, which is one of the higher readings that we've had over the last year or so. But the absolute carnage that occurred back here during the coronavirus wipeout was basically double the volatility that we're experiencing right now. And you can kind of sense that just by looking at these bars to the upside and to the downside, and then comparing them to what we've been dealing with over here, which has felt volatile, but in comparison to March of 2020, we ain't seen nothing yet, right? That's kind of the mindset there. Now, it doesn't mean that we can't find some value in this area, and it doesn't mean that we for certain are going to head towards this type of a market. This was a very one-off, unique black swan type of a situation. Nonetheless, it is helpful to remind yourself that this is not necessarily the worst that it can get. It can get worse than what we've been dealing with, even though it has felt pretty nasty here lately, especially in the technology and growth-oriented areas. All right, let's go ahead and do some more analysis here using chart 4B. This is our more traditional market forecast grid here. And not a whole lot has changed since I was last with you on Tuesday, because that was the day that we went back to the bearish postures with the exception of the Dow Jones. Today, I can tell you that that is now changed. Now the Dow has joined the other 3 indices with bearish postures. However, you will notice that the Dow has a light pink background color. So notice the lighter shading of pink here on the background compared to the dark pink, dark pink, dark pink. So those dark pinks are meant to describe a strongly bearish posture, whereas the light pink is a weakly bearish posture. But keep in mind that if we are to sell off tomorrow, right now futures are holding pretty steady after hours. Initially, the futures had sold off when it looked like Microsoft and Alphabet were going to torpedo lower, but now that they've kind of recovered a little bit, we're basically flat with the futures as we stand right now. But if there is a continued sell-off tomorrow, I would anticipate that the Dow Jones will go to a strongly bearish posture as well. And the reason I say that is this green line right here that kind of sets the posture using that market forecast technical indicator is sitting at 53 and falling right now. Remember, it only has to go below 50 before that background color starts getting plotted dark pink and will join the rest of them. So while the Dow continues to be the leader from a bullish perspective, it's only because they are doing well on a relative basis, not on an absolute basis, right? You're still losing money in the Dow Jones Industrial Average. You're just losing less money than you are in these other three indices. So today the Dow was only down 2.38%, and I use only quite loosely in that case because, of course, that is still a very terrible day for the Dow Jones Industrial Average, but it did outperform the other three indices here. You can see that the S&P 500 was down 2.81%. The Nasdaq Composite, as I mentioned before, terrible day. And it was the worst offender here today, down 3.95%. That was woof. One of the worst days you'll come across on any given year. So that was a terrible, terrible day for the Nasdaq Composite. The Russell 2000 wasn't quite as bad, but it was still worse than what we saw in the S&P 500. The Russell 2000 was down 3.26%. So remember, Russell 2000 is where you're going to find your small cap stocks. Those ones are going to be much more aggressive, higher reward, higher risk types of names that are in there, and they can be pushed around a lot more easily because their market caps are so small. So when we have big, aggressive, either bullish or bearish days, you find that the Russell 2000 tends to operate in a little bit more extremes than what you will find with the Dow Jones Industrial Average. However, if you were trying to normalize that across all four of these, be aware today was, of course, an extreme day for all four. We know that because of this colored label up at the top of all four of our charts where it talks about the daily range. Those colored labels are all orange. And what that means is that today's range was more aggressive than the average true range recently. And if that was not the case, those labels would be blue. And so that's another identifier there that today was an extreme day. It wasn't just something that was a walk in the park. It was an aggressive sell-off day. And not only that, but of course, it's not a good look for the markets when you're closing at the lows. And that was effectively the case on all four of our charts here today. You'll notice that there doesn't appear to be any lower wicks below these red bars, right? What these red bars signify, for those of you that are not familiar with candlestick analysis, is basically you started the day in the upper left-hand corner of that kind of rectangle, and you ended the day when it's all filled in red in the lower right-hand corner. So your highest print of the day was the opening print, and your lowest print of the day was the very final print, which basically means this was a trending day that started high and ended low throughout the day. Not a good look because it generally gives you the sensation that if the markets would have been open for another hour or two, we probably would have had even further selling, and the Nasdaq probably would have been down more than 4%. So in a way, it was kind of like the closing bell was kind of saved by the bell, right? It could have gotten even worse had it been left to its own devices. So terrible day, across the board. The other thing that I would point out that we don't always get a chance to point out, but there's additional labels that are showing up at the bottom two charts here. So notice on the Nasdaq Composite, right where I'm circling down and to the left, it says yearly low today. And we're getting the exact same pink label here on the Russell 2000. So, while we only have the room to kind of look at 3 months worth of data when we're looking at this 4-grid view like we are right now, these labels will go back the full 12 months to determine whether we've got new 52-week highs or new 52-week lows. And so that's not a good sign there either. The Nasdaq Composite and the Russell 2000, which are big portions of the overall investable universe, are both hitting 52-week lows today. I talked about the Nasdaq already having broken those prior horizontal support areas But you could really get away with saying the same thing here with the Russell 2000. And remember, for a while, the Russell 2000 was acting like it wanted to outperform it. It refused to go lower during this, minor time period here, kind of in the middle of March, where it did not breach that prior low from February, whereas the Nasdaq did. It did breach that low. So for a while, it kind of seemed like, well, maybe, just maybe, we could see if the Russell 2000 was attempting to form a bottom. But you got to throw that out the window after today as well. We closed at the low, broke through that prior low that was on the Russell 2000 on February 24th. And remember, the Russell 2000 has been a little bit different than these other three in that it had been more bearish for a longer period of time prior to that. So while the Nasdaq is just hitting a one-year low right now, it's possible we'd have to go back even further on the Russell 2000. Let me right-click on that chart and go to Maximize Sell, and then let's pull up a longer time period here. Let's go back on a 3-year chart. And I'm just going to change it to weekly for a second here. And I just want to see how far back we would have to go since the last time it was trading here. And you'd basically have to go back to, it appears to my eye, basically this candle right here. So we're talking about the lowest levels on the Russell 2000 since December of 2020. So quite a long time ago. Obviously, you don't need me to tell you it's been a difficult run for small cap investors along the way. So I wish I had better news to share with you, but it is continuing to be quite a bearish experience here in 2022. With the S&P 500 and the Dow Jones Industrial Average, we just barely have yellow 30-day moving averages, which at this point means the moving averages themselves are still rising, even though prices are below them. But down below here, where we're kind of separating our winners and our losers in various ways, remember, on a relative basis, the Dow Jones is probably our best performer. On a relative basis, it's either the Nasdaq or the Russell 2000 that are our worst performers. And one other way to identify that is looking at the colored lines themselves. That 30-day moving average for both for the Nasdaq Composite and for the Russell 2000 is red, signifying that the moving averages are now pointing lower and price is below them. In fact, one other thing that I just noticed, considering our two losing charts at the bottom, here's something that's pretty rare that you don't see very regularly. The momentum line is literally as low as it can possibly go on both of them. That red momentum line is 0.00 on the Nasdaq Composite, and it is 0.00 on the Russell 2000. That is extreme, right? You can look at these red lines down below and see that it sometimes gets to, maybe 2 or 3 or 4, but it is pretty darn rare for it to close exactly at 0. And basically what is required in order for that to happen is for us to have a massive sell-off day and for us to close at the exact lows. And that doesn't happen all that often, right? A lot of times you kind of get lucky and you get a little bit of a lower shadow there, kind of like this candle. You got that little lower shadow or wick underneath the rectangle. But today was an aggressive sell-off day where you basically closed at the bottom tick. And so that's the only way that can happen. Tomorrow it'll likely come off of 0, but nonetheless it does go to show you how awful this market was today. Just one more example of that. Let's go ahead and step away to the internet here briefly. I always like to get a chance to say thank you to those of you that help support these videos. And the last time I did the video here on Thursday, 105 of you took the 5 seconds out of your day to click like, which is why I'm doing a full-length video for you right now. Remember, if we're underneath that triple digits, then I would more than likely than not just do a 15-minute version of the video. So with the importance of today's massive sell-off, I for one am glad that I have more than 15 minutes to dedicate to this, because we got a lot to talk about here in today's video with all of the plunging markets around us. So thank you to all of you who support that. Remember, it takes David and I a minimum of 3 hours to do these videos, even though you guys might only watch a 30 to a 1 hour segment somewhere in that general vicinity. It takes David and I well over 3 hours all in to do everything that is required of these videos, including all the research and the prep and the uploading and the editing and writing up the paragraph right up above here. You'll see that this is not just something that you snap your fingers and it's done. You actually have to write all of this. So there's a ton that goes into this, including sending out all the emails and the social media notifications and all that kind of stuff. So, there's a lot more that goes into this than what you might assume, and we don't charge you a cent for it. So all we ask out of you is to help support us. And if you want to see these videos as often as possible, then we would encourage you to click like. Now that's assuming I'm in town. And as I mentioned before, I will be heading to Omaha this weekend, and I'll actually be flying out on Thursday, so I won't get a chance to do this video on Thursday. As far as I know, David should be with you on Wednesday and Friday this week, however. So no video this Thursday, but I will be back next Tuesday, a week from right now, and we'll plan on doing the market outlook video for you that day. And we'll see what sort of chaotic markets appear between now and then, and also hope to get a few thoughts from Warren Buffett and Charlie Munger about this. Of course, Warren has now been investing for 80 years, so he's seen a few of these pullbacks along the way and usually has some pretty good words of wisdom to share with people about how to handle these types of moments. Also, while we're over here, just a reminder that I did teach my dividend growth investing class today. Remember, in that class, we are buying businesses for the long term, and we actually got to buy a business today that we have not yet bought here in that particular class since I've been teaching it at Market Scholars in the last 4 years. We did buy this particular business when I was teaching dividend classes 4 or 5 years ago or whenever it was at TD Ameritrade. So it's not a completely brand new name, but it is a reminder that when we have chaotic markets like we've had here more recently, it does open up long-term opportunities for some businesses that you felt might have been too expensive in recent time periods that have now fallen to more reasonable valuation. So if you are a premium member of Market Scholars, feel free to watch the recording that's up here on the Trading Room's calendar. I've already posted the recording there if you are curious what stock we bought in my dividend growth investing class. And then David taught his directional option strategies class, and of course does a masterful job navigating these markets through the world of options trading. Tomorrow, I'll be back in action with factor-based swing trading at 11 a.m. Eastern Time, and then David will be doing his options inventory trading class at 2 p.m. Eastern Time. So lots of great content heading your way. Also, while we're over here, let's go ahead and take a look at our sector selector tool. A reminder that this gets updated over the weekend, so this is a couple of days old at this point, but will still give us the general idea as far as any rotation that may or may not be taking place. Energy did remain number one, and it did okay today compared to a lot of the other sectors. But remember, this is always on a relative basis, so it is possible for all the sectors to be underwater for a period of time, but there's always going to be one that's an outperformer, and there's always going to be one that's an underperformer. So right now, while there's been a little bit more wear and tear on some of those energy charts, where some of them are starting to break trend, and that was not the case in recent months. So I do want to kind of point that out, and I shared that with my class on Monday as well, that there are some of those oil and gas stocks that were in significant uptrends that have started to trade below their moving averages. So be a little bit more cautious around them, but they are still outperforming the absolute plunging that is happening in other sectors that are out there, including the communication services sector. And for those of you that watched the price activity in the market last week, you're probably not surprised in the least that communication services is now dead last as a result of what we saw with Netflix last week. Remember, it was down like 35% in a single day, and it took a lot of the other internet names right down alongside with it. So that did put a very negative sentiment into the communication services group. And then technology, consumer discretionary, they're all at the bottom. And remember, those are some of the areas you want to see collecting attention if you're really bullish on the markets. So if anything, you could say that this graphic is exactly upside down from what you'd want to see if you wanted to be really bullish in the markets right now. You don't want to see utilities, consumer staples, and real estate up there in the top 4. Those are all defensive areas, and they usually provide a little bit of comfort when markets are chaotic and folks want to hunker down in the Coca-Colas of the world type of a thing. What you'd prefer to see is for a risk-on mindset of folks chasing Amazon and Tesla in consumer discretionary, or Apple and Microsoft in technology, or Facebook and Google in communication services, right? Those are your go-go momentum types of names that have offered spectacular earnings growth and stock rises over the last 5 to 10 years. But we are seeing that those are the exact companies that are very much out of favor right now. So not a very good look here from the sector selector, at least if you want to be bullish in these markets. All right, let's get back on track with some more charts. And let's do some 12 grid analysis on chart 5A. This is our asset class 12 grid. And a reminder that the background colors of these 12 grids will be green if the current posture of the chart using the market forecast technical indicator is bullish. It'll be pink background if the posture is bearish. And so, as has been the case more times than not this year, it's the bottom rung that provides our bullish examples. Right now we still have the US dollar, oil, and Treasury yields with bullish postures. Now, of those, you will see that it's really the US dollar that is acting like a superstar right now. US dollar has been up 4 days in a row. Now remember, in the grand scheme of things, of all the currencies across this planet, the dollar is kind of perceived the way that you would perceive the Dow Jones Industrial Average versus the Nasdaq Composite or the Russell 2000. In other words, it's the big, bulky, liquid asset. And it is oftentimes viewed as more of a safe haven. Sometimes people would say it's probably the best house in a bad neighborhood because a lot of the currencies around the world are being inflated, as governments are stretching for dollars wherever they can. But it is true that there is some perceived safety in the US dollar. And when we have chaotic financial markets, you do tend to find the US dollar benefits, all else being equal. And so the dollar is really taking off. For those of you that reside here in the United States as I do, perhaps we should be booking our European vacations or, Asian vacations or South American vacations or even African vacations. I once made it to Kenya myself for a safari. So, I'm happy to go wherever. But, if the US dollar is strong, it's going to make that trip a little bit more affordable for folks. Of course, if you're an investor in the US markets, you might feel a little bit poorer after the recent trading sessions. Nonetheless, at least the currency is stronger. Now, while that sounds good from the perspective of an American, I will be the first to tell you that I actually prefer when the US dollar is weak. I've found that the trading of the stock market is easier, at least on the bullish side of the equation, when the US dollar is weak. That's when you have a lot of your multinationals doing a little bit better, and that's when you have a lot of foreign securities that are open to you that are doing a bit better. So right now, it's the opposite of that, right? The dollar is strong, and what that means in turn is that foreign assets are going to be weak, all else being equal, and you'll also have a little bit of wear and tear on the commodities. And while oil has kind of been in its own universe here lately, it managed to close higher by 2.4% today. You see that gold didn't really go anywhere. It was flat, but really the story behind that is it gapped lower yesterday, and it didn't make any sort of progress in filling that gap here today, so it stayed low. Notice how gold looks quite a bit different than the way it did just a few weeks ago. We were, singing the praises of gold here not so long ago as it was in this nice uptrend. But all of a sudden, we have a strongly bearish posture on gold, and we have a falling 30-day moving average with price below it, which is why that moving average is now red. And we also had a broken kind of support level, or at least right at a support level from back here on March 29th. And that kind of plays into what I showed you there on the sector selector a moment ago, where materials did fall one notch, right? They only fell from number 4 to number 5, but this was as of Friday night. Some of you that were watching the markets yesterday might have seen that the materials really started spilling over. We actually had to slim down on some of our materials holdings in my trend trading class yesterday as a result of that. Kind of came out of the blue because materials were doing pretty well, but all of a sudden, even some of those metals and mining areas are starting to struggle. Again, the good news is the oil stocks are still doing okay, but we are starting to lose some of that leadership in the other commodities areas like those metals and mining companies. So keep your eye on that possible trend reversal, because it used to be a bullish trend for the metals. We're starting to see that starting to slip into more of a bearish trend all of a sudden. So not a good sign there when we're starting to lose some of our key leadership areas. Remember, it was already hard to find outperforming assets. It's just made it even harder in the last few sessions as a result of some of those commodities starting to slip a little bit more aggressively. So gold has a strongly bearish posture, oil continues to have a strongly bullish posture, and it's basically sitting right on the upside of its 30-day moving average, but just barely. It's basically sitting right on it right now. So it could really break either direction. After a huge move earlier in the year, oil has largely kind of settled into this more sideways pattern right here, and it could really break out or break down. Right now you're in the middle of the range, so we don't know yet, but the path of least resistance does continue to be to the upside according to the moving average itself. And then Treasury yields did slip just a little bit here today. This is actually the third straight down session there on yields themselves, but because they had such a massive head start, even a 3-day sell-off is not enough to change the background color away from dark green. So in other words, this continues to be a strongly bullish posture on Treasury yields at this moment in time, which also means that long-term U.S. Treasury prices, the bond prices themselves, remain in a significant downtrend despite a little bit of a reversion to the mean type of a move here over the past week. This is still a very ugly downtrend for most bond markets at this moment in time. With the dollar being strong, no surprise at all that foreign stocks also got whacked here pretty good today. Foreign developed stocks were down 2.79%. Foreign emerging market stocks were down 2.19%. And you can see that the foreign emerging market stocks are very close to breaking their prior low from March 15th. One more flush tomorrow, and it'll be new lows on those foreign emerging stocks. With the developed stocks, they've got a little bit of extra room to go, but even that's not out of the question. If we continue to have bearish days throughout the rest of this week, we could be looking at the emerging markets and developed markets joining the Nasdaq and the Russell 2000 at fresh multi-month, if not multi-year lows. Let's go ahead and now take a look at our sectors and see if there's anything to get excited about there. Probably not, given what we've already discussed in this video. But having said that, when I pull this up, I am a little bit surprised to at least see one green chart on the board, and that is down here at the bottom. The consumer staples still manage to have a strongly bullish posture. And again, think about Coca-Cola and Pepsi and Procter & Gamble, and we talked about last week Kimberly-Clark. Those types of companies are generally perceived to be quite boring. Now, they're all excellent dividend growth companies, right? They're all, dividend aristocrats, along with, Clorox and Colgate and Walmart. All those types of companies have long histories of raising dividends and oftentimes are perceived as a safe haven of sorts within a risky asset class like stocks. So this is a market that prefers the most boring names that are out there, and they happen to find themselves in the consumer staples area. Now, having said that, they were still down today. They were down over 1%. It's just that they had such a nice rally off of those lows. It's kind of interesting with the staples. They put in an oversold cluster signal here on March 11th, and that actually called the low, and we went straight up after that oversold cluster signal all the way up to this overbought cluster signal, and wouldn't you know, that actually ended up being the high thus far, and we've sold off since then. So because that was such an aggressive move between those two dots, we still retain that strongly bullish posture because the intermediate line is still in the upper reversal zone. Remember, if it were to fall from 84 down to below 80, then this background color will change. But we've got a little bit of wiggle room there to work with at this moment in time. But that's it. All the other charts are pink at this moment in time to one degree or another. In terms of other charts that are at least having some semblance of stability, I would probably point out that real estate can actually make the claim that it's sitting on its moving average right now, whereas all of the other charts you can see are trading well below their moving averages, and that includes energy. Right? While energy is still up 13% over the last 3 months of this chart, the last week has not been particularly good for oil companies, and you can see that we are well below that 30-day moving average at this moment in time, even on that stellar outperformer on a year-to-date basis of energy. So really, it's staples are well above their rising moving average, and so they're kind of your go-to place right now for any sort of, relative strength, and then real estate is kind of right there, at least making a case for itself. And then after that, you could probably go utilities, which is still a little bit below the moving average, but not dramatically far away. And then you kind of have your energy conversation there as well. But a lot of these other charts, look at them. It's a massacre out there. These things are just falling off of a cliff. Technology down nearly 4% today, ends with an oversold cluster signal. Communications down over 3% today, new multi-month or yearly low, and oversold cluster signal today. Even the financials, they closed at a new multi-month low here today. They didn't have an oversold cluster signal, but they're probably getting pretty close. Remember, if you need to see that, you can right-click on the chart and then go to Maximize Sell, again, assuming you're a premium member of Market Scholars who has access to all of our charts. And then down below, once you do the Maximize Sell, you can see the actual market forecast technical indicator, and you can see how close we were. I didn't realize it was this close. I mean, we were within a hair on the financials of having an oversold cluster signal. The green line ended at 20.21. Remember, if that were at 19.99, it would have been a cluster here today on the financials as well. So, for all intents and purposes, it effectively is a cluster even there on the financials, or at least the general sensation is an extreme sell-off. Discretionary got annihilated today. Now that's because of Tesla, right? Tesla is going to be the most influential member of discretionary alongside Amazon. So when Tesla's down 12% today, it's going to have an overwhelming impact on XLY. It was down 5% today. Industrials were down 2%. Materials were down 1.5%. And even healthcare is getting, quite long away from that moving average. So those charts do not look good, right? Those moving averages are way above the price activity. So, that's telling you a lot about this market right now. The market does not want to take on risk. Where it feels comfortable to some degree is consumer staples, maybe a little bit of real estate and utilities, but otherwise, this is a market that's selling first and asking questions later. All right, let's get into our trade application example here for the day. And as I'm sure you guys are not surprised to hear, I did yet another sold put trade. And, I've been doing much more concentrated put selling this year than at any other time that I've been doing these videos over the years. And that stretches back to my time with TD Ameritrade as well, when we used to do the market forecast video back then. We've, of course, since changed it to the market outlook video. But the point being, there has not ever been a time in all of the years I've been doing these videos where I've had such a concentrated amount of sold put trades. But that's because of what I had referenced before. We are now in a more volatile time period, and that is the time period that I want to sell puts. That's where I have found where I get the most bang for my buck. And remember, selling puts is a bullish strategy, but it is a mildly bullish strategy. And that's an important takeaway as well. I had somebody, tell me that on the I think it was the Scott's Miracle Grow trade. They're like, I bought calls on that and I got hammered. And I'm like, well, there's a reason I didn't show you to buy calls. When you are buying calls, it's like the most aggressive bullish thing you can be doing. There is a reason that I use the language of selling puts is a flexible way to be bullish, but not to be aggressively bullish, right? There's a reason why we select the strategies that we do. And if you're doing a whole bunch of long calls on the same exact charts that I'm selling puts on, you are going to have a dramatically different experience than I am. This is a market where I want to be more timid because I don't really trust this market. It is more bearish this year, and therefore I don't want to get too aggressive on the bullish side of the equation, which is why when I do bullish trades, I want them to be very timid bullish trades where I've got lots of flexibility because, of course, I'm selling out of the money puts. So this is an extremely rare time. I just happened to be looking at the monitor tab earlier. This is an extremely rare time where every single one of my open trades for this presentation are sold put trades. Now, part of the reason behind that is I did do a swing trade on that Lindsay Corp a week or two ago, and we were stopped out of that, unfortunately. So we did take a loss on that one. But all of my remaining trades that I've done, every single one of them are sold put trades. Now, we'll get to Comcast here in a little bit. As you can see, that was the fill I got earlier today, and that will be our trade application in tonight's video. But I did want to remind folks of where things stand with those prior trades that I put on during this presentation, because you might be wondering, well, if you keep on doing these bullish trades while the markets have been just downright bearish, aren't you getting run over? And the answer is, not really. I mean, are we experiencing a little bit of pressure? Sure, but it's not like a bloodbath the way that it would be if you were doing other bullish trades. And that is, again, the point of me selling the puts as opposed to choosing other bullish trades that are out there. So we do have open orders still on Best Buy, Comcast, which we'll talk about tonight, JP Morgan, Kellogg, Polaris, Phillips 66, Starbucks, Scott's Miracle Grow, and Whirlpool. Those are literally all of my trades that I've done here recently that are still open for this presentation. And if we were to go through those, because again, it's a natural question to wonder, are we in trouble by doing so many of those bullish trades? And I'm happy to report that at this moment, we're not. It doesn't mean that we won't be down the road, but as of this moment in time, we're still in reasonably good shape. So let's go through them here quick, since I'm not going to be in the video on Thursday and we won't have the opportunity to review it there. We'll make tonight's a little bit longer again. But with Best Buy, remember we sold the $80 put. It's trading at 92 right now, so we are only in hot water if it comes down here to 80, which will be well within that blue zone of the dividend stair-step chart, where it will be in a more attractive dividend yield candidate at that point. That's a May contract, so that'll roll off the books here in all likelihood in a few weeks. We also have JP Morgan. And JP Morgan has been selling off recently, and you can see it's almost made its way into the blue zone of the dividend stair-step chart, but not quite there. It still is going to require another dollar or two. But with JP Morgan in this video, we actually sold the 105s. Now that was for the month of June, so there is more time for that to go wrong. But you can see we still have a lot of headway between 123 right now and 105, where we would be required to buy that stock if it got down to that level. The next one was Kellogg. This one's a little bit of an oddball one. This is not one that we did recently, but it is still live on our account right now because it was one of the rare examples where we had sold a put that was a leap contract, so it actually doesn't expire until January. But there we sold the $50 leaps, which is way down here. And of course, Kellogg has actually been benefiting in this recent market environment because everybody's kind of drifting towards those consumer staples companies. So we're in great shape on Kellogg. Polaris was another one, right? That's a more dangerous one because it's a smaller company in the consumer discretionary space. But even that, remember, we sold the $80 puts on Polaris. It's trading at 98 right now, so we're still in good shape on that one. The next one was Phillips 66. And we sold the 55 May contracts on that one. And you can see 55 is way the heck down here. Even though it's trading here at 81, our obligation is not to buy it unless it falls all the way to 55. The next one was Starbucks. This one has been struggling here, but again, we're still in reasonably good shape with it. It's trading at 75 right now. Our obligation is at 65, so we still have another $10 of flexibility before we get into, hot water on it. One of our more recent ones that we did there was that Scott's Miracle Grow that I mentioned before. And as you can imagine, it's gone down with the market in recent sessions as well, but that's part of the reason we gave ourselves so much flexibility when we sold that put, because we sold the $75 put, which is way down here. It's trading at 101, so we still have an additional $25 to $26 for it to fall before we get into hot water. And then Whirlpool. Remember, this was actually one of the few bright spots here today. Whirlpool came out with their earnings. They were actually up 4% on a day like today where the market got massacred. So we're in really good shape on that one, where we select the 140 strike. And that was for the month of May here. So with it trading at 187, we've got more than $40 of margin of safety at this moment in time. So you can see I just rattled off 8 of our open trades, every single one of them bullish trades, and not one single one of those 8 trades is in the money yet. So in other words, you can make money on the bullish side of the equation, even when the stock market is in a foul mood like it is here recently, but it is incredibly important to choose the proper strategy, which is why I selected selling puts as opposed to buying calls or, buying call spreads or anything else like that. So, so far so good. And again, we got to be careful there because market likes to serve up nice portions of humble pie to you on occasion. And it is entirely possible that, some of those that I just rattled off can get us into hot water in the next month or two. But right now, I am happy to report that we are still in reasonably good shape, despite doing bullish trades in this quite bearish market. So that takes us to our trade application example for tonight. And as I already mentioned, it was on Comcast. So let's pull it up here on the chart and talk about what I kind of liked about this trade setup. So Comcast is maybe not as well known of a dividend growth stock as something like Kellogg's or something like that, right? But it's still got a pretty good history of raising the dividend throughout time. The reason that you don't hear us talk about it as much as Kellogg's and some of these others is because it usually doesn't have all that big of a yield. But with it having grown its dividends throughout the years, and with this stock now starting to tumble over the way so many others are, it's starting to get a more respectable yield here over all of a sudden. You'll notice that with today's sell-off, so it was down about 2.5% today, so it slightly outperformed the market. But it was still a pretty decent sized sell-off. Its dividend yield is now 2.42%. Now you can see in our average high yield label, and again, condolences to the Geraldine Weiss family. She was an inspiration to me. She is really the inspiration behind these dividend stair-step lines that I eventually took to TD Ameritrade when I worked there, and then of course now here at Market Scholars. And some of you might not know, but she was the one that wrote the book Dividends Don't Lie back in the early 1980s, and she just passed away unfortunately yesterday at the ripe age of 96. So she led a full life, and I owe her a lot because she really inspired me with her work over the years. But anyway, what she would tell you and what I will tell you as well is each stock is different when it comes to their dividend yield history. And for Comcast, it's usually a company that has a smaller yield than something like a AT&T or a Verizon or something along those lines, or an Altria, right? Some stocks always have high yields, some stocks always have low yields, and then you have a mix of everything in between. So Comcast tends to be on the lower end of that spectrum, and typically is a reasonable candidate for a long-term investor when it has a yield of 2.15%. So even right here at a 2.42%, it's at an abnormally high yield. And you can see that with today's sell-off, its weekly bar thus far has this little green dot underneath of it, which signifies that we have an oversold cluster signal using the market forecast technical indicator. And you'll notice that the last time we had one of those little green dots show up on Comcast specifically was back here in April of 2018 when it was trading at around $31 or $32. And that eventually called the low during that time period, and it eventually went on to all-time highs. Now, I cannot offer a guarantee that this will call the low here either, which is why I'm playing it safe by selling a put. And the put that I sold, as you probably saw on the monitor tab, was the June 35 puts, and I was able to get 38 cents for it. In fact, since it sold off throughout the rest of the day, those of you that got the trade done later in the day, because remember I send out the telegram to all of you who are premium members, you might have even gotten better fill prices than I did on this platform here. But nonetheless, at $35 down here, that's actually below this yellow number at 36, which signifies that's what this stock would need to trade at in order to have a 3% dividend yield. Not that that's the biggest deal in the world, but for those of you that might have a minimum yield hurdle of 3%, by selling the $35 put and putting yourself in obligation to buy it if it's trading down below that level, then at least you have the background knowledge of saying, yes, if it falls from $44 all the way down here to $35, then I will take ownership of it there and I will start my journey as a long-term investor on Comcast with a very acceptable and rewarding 3% dividend yield on a company that hardly ever even has close to that, with usually the average is closer to 2%. So, again, the only reason we can pull that off is because volatility spiked today. We do have to hold through an earnings announcement, so do keep that in the back of your mind. That'll be 2 days from right now, so that plays a role there as well. But that gives us that nice margin of safety from 44 down to 35 to be wrong, and we collect that premium up front that we received here today when we did the trade, and now we're on the hook for buying it at 35 if it gets down there. But if it does, it should be a pretty attractive long-term investment as long as you assume the business is safe. Okay, so that's what I had for you. Hope you got a lot of value out of tonight's video. A lot to discuss with the plunging markets. Again, I'm going to be out of the office this weekend heading to Omaha, so feel free to follow me on Twitter at Brandon Van Zee if you want to hear all about my trip there as well. So until next time, I want to wish you all the best of success with your trades and your investments. Please click like for me there on Twitter if you got value out of the video, and David should be back with you tomorrow. Take care, everybody. Bye-bye.